Signature Guaranteed Universal Life product. I've got an overview of the product, number one. Number two, kind of a competitive analysis of it. Number three, I'm going to talk about the riders. Four, I've got a sales idea around it and another sales idea. So two sales ideas for the price of one, and should be really great. This is a really exciting product for us. In case you might recognize me from my advisors resource company, we actually have partnered up with American National to become a regional office for American National. We found that American National has some really great products, really great fit for the type of agents and clients that we're working with. And so we're just really excited to share the opportunity. That's not the point of this discussion today. I'd be happy to talk with anybody about that in the future. So just let us know about that if you want to learn more. But today the primary goal is to go over this product. So let me get my presentation up here. Move all my screens around. Sorry, guys. And I do have a Q&A going on the, I can see questions. So if you have any questions, feel free to chime in and ask them. But it is, well, it's after 11 now, so I better get started. So American National, it's a great Texas-based company, has the signature guaranteed UL, and really kind of an overview of it is guaranteed death protection, death benefit protection, that is, accelerated benefit riders for critical and chronic illness, and then uniquely, at least in today's age, a guaranteed cash out rider. It's really a return of premium rider, but they call it the guaranteed cash out rider. It's guaranteed return of premium in various years, but I'll speak more to that in a minute. Let's just go right off into the comparison of the competition out there. So American National really hit the mark with our product here. This is a comparison of male age 50 GUL with the premium of $1 million face value. These are guaranteed till all of these are guaranteed out to max age, so 121. Typically, some of them vary just a little bit. But as you can see, American National is by far, maybe not by far, but by a significant margin, the most competitive product. This product performs extremely well under a 10-pay scenario, so I wanted to bring in a 10-pay illustration just to demonstrate sort of where it fits. So 50-year-old male, this is a preferred illustration, guaranteed out to 121. Total premium of $237,000. So you can exchange $237,000 for $1 million at mortality effectively. That's actually a pretty good guaranteed internal rate of return if you think about it for this particular client. And obviously it includes the critical and chronic illness riders, the guaranteed cash out rider, which I'll get into that right after this. But for a total premium of $237,000, which is basically $23,000 a year, $23,700 for 10 years, we have a pretty competitive offering in general. And feel free to ask any questions about this particular part, but this is dealing with the accelerated benefit riders. So inside the illustration, we have some various attained ages, various ailments based on the severity of the ailments and how much discount the $1 million death benefit would receive if you accelerated it for any of those purposes. So chronic illness is, anybody that's qualified for LTC basically. So can't do 2 of the 6 ADLs, has a cognitive impairment. Then you can accelerate it for chronic illness. Critical illness, and I think later in this presentation, I have a list of the ailments for critical illness. But critical illness is any ailment that is expected to impact significantly somebody's life expectancy. So, like heart attack, cancer, stroke. I mean, there's quite a large list of different ailments that can affect somebody's life expectancy. But this is essentially how much the client would get if they accelerated the $1 million death benefit and had a mild impairment, moderate, or severe impairment. And so that's just kind of a grading scale. What essentially, if you want to know, what essentially the company is doing is saying, okay, you decide to accelerate the death benefit at this point. We're going to estimate how much longer we think you're going to live. So, like if you have stage 4 cancer and you're 70, you're not going to live as long as if you had, some sort of, like stage 1 colon cancer. So the stage 4 may be a severe impairment because, that you might live for whatever, 5 years. So they're going to discount it based on that estimation and apply some sort of interest rate. Generally, it's some sort of market interest rate, but that's how they determine how much can be accelerated for those benefits, which I think is kind of interesting. It's sort of to combat that life settlements market, you might say. The other really interesting feature about this product, and this is based on the 10-pay, is the guaranteed cash out rider, guaranteed return of premium rider. So in year 15, you can surrender the policy, cancel the policy, and get 65% of your premiums back up to 65% of your death benefit, which in all honesty, unless you're table rated, you're not going to hit that 65% of death benefit number, unless you've got a table rating or something like that. So in year 15, you could get 154,000 out of the 237 that you've put in. In year 20, you get 100% of your premiums that you've paid back, and that ends up being 237,000. And then again, in year 25, you get the 100% of your premiums back if you decide to surrender the policy. So this is quite unique in GULs. Years ago, there was some products that had these features, but I think this is a really cool feature in that if you decide after 20 years, you don't want the coverage, cancel the policy, get all your money back. Then you have another chance at year 25 to do the same thing. I would probably not recommend anybody canceling it at year 15 because, if you could just pay it out till maybe year 20, you're going to get, 35% more of your money back. So you might be better off like going and, borrowing against your house if you're really in that situation or something like that. So there was an answer on here. Here's an answer. There's a question on here that I'd like to answer. Does it adjust with an all pay? So, if you're paying for all years and in the 20th year to get all the premiums that you paid back. I actually have an example of that coming up and you'll see, but yes, the answer is yes. So if your premium was like 10,000 for life in year 20, you could get back 200,000. In year 25, you would get back 250,000. So that's a good question. I'll move on from here. I gotta move this. Sorry. Okay, so this is just the ledger, just to show you. So you've got surrender value, which, because this is front loaded, is a little bit higher than zero. You're not doing this for the surrender value, but you can see this is a 10-pay, so it goes for 10 years and then goes on from there. There I have the cash out values as well. So just an example. And then to the person that asked about the all pay, this is an example of the all pay. Similar payouts with regard to the accelerated benefit riders. And then if you look right here, you've got the guaranteed cash out rider. Year 15, you're looking at 65% of the 150,000 that you put in, which is 100,000. You're 20 and 25, it's 100% of the premiums paid, which ends up being 205,000 and 257,000. So relatively straightforward with regard to that. And it's a pretty sharp product. This is just simply the ledger for what I just discussed. And that goes all the way out. Keeps going. I got another question here. How long is the surrender period? It is, I want to say it's a 10-year surrender, but I can actually go back. You're not really, I mean, this actually has no surrender. So let me go all the way back, but the main thing you want to look at is the guaranteed cash out portion of it. Yeah, it's a 10-year surrender. So it really only has surrender value if you sort of front load it. So again, just touching on those accelerated benefit riders, I have critical, chronic, and terminal illness. Here's the ailments that typically qualify for the critical illness. So like I said, cancers, heart attack, organ transplant. There's quite a few here. So there's actually a more extensive list in the illustration. And then when it comes to the chronic illness, like I said earlier, it's 2 of the 6 activities of daily living, and or has some sort of cognitive impairment. And then terminal illness is pretty standard. It's not expected to live within 24 months. Or not expected to live longer than 24 months. Some more info on that guaranteed cash out rider. This is directly from our brochure, and really it's just reiterating the amount that you can get out. If you are under 250, they lower the initial amount on year 15, how much you can get out, to 50%. And the max that you can get out of is 45% of the death benefit. For the rest, it's for above 250, which is really where you want to see this product, is 250 plus. You're looking at 100% in year 20 and 25, and then 65 in year 50. So two ideas how we can use this product. Obviously, this is a pure death benefit play, a great alternative to non-guaranteed IULs, things like that. And I'll answer this question a little bit later. Sorry, an alternative way to accumulate cash. So we have life insurance as an asset class. So the specifications on this particular presentation is male, age 50. We're doing preferred again, and we're doing a 10 pay on this, and I'm assuming life expectancy is somewhere around 85. So what we want to do is really look at what is the internal rate of return at life expectancy, and what is the pre-tax internal rate of return at life expectancy again. And really, if you think about this, in this particular product, we're getting 4.8% internal rate of return guaranteed. If you look at the pre-tax number, because very few assets are taxed like insurance, you're looking at a pre-tax IRR of almost 7%, and think about it, that's guaranteed. So this is an extremely good deal, especially when you're thinking about somebody who maybe has an annuity on the sidelines that they're just saving for their kids or grandkids. Maybe they, aren't going to touch their IRA because they're going to pass it on to their kids and grandkids, and they put it in CDs or something like that. So when you look at the IRR on death benefit, it becomes very clear that this could be a very powerful financial tool for somebody's toolbox, in that the guarantees are here. and it's the tax benefits as well. So what we put together in this proposal, and we could do this proposal for you if you'd like. It's a pretty simple proposal. This is all sort of on a one page, the next couple pages that you're going to see. But what we show is internal rate of return over different ages. So, 85, your IRR is 4.8. Pre-tax IRR is 6.8. If maybe you live out to 95, your IRR only drops down to 3.6, and that's still a 5.1 pre-tax internal rate of return. So the taxable equivalent yield would have to be over 5%. So the point of all of this is, no matter how long you live, if you win and you live a really long life, this still ends up being a really good deal on a guaranteed basis, because you have to remember, where else can you get a yield of 3.6% today, over a 30 or 40 year period? And where can you get a, pre-tax yield of over 5%? Guaranteed. I mean, you got to keep in mind, this is 100% guaranteed, backed up by the claims paying ability of the insurance company, but also the state guarantee funds, because again, this is contractual. So it's quite powerful. I mean, there's a lot of backing behind this. And, this graph just simply demonstrates how powerful this can be as an asset class, as a alternative. So what I like to show also is where are like the crossover points. So this is if you took the premiums, which was a 10 pay of 23,700. And if I invested this at 4%, where would the crossover point be, which is in green? So at 35, if I invested, 237 or 27,000, or I'm sorry, 23,700 over a 10-year period, and earned 4%, I'd only have 555,000 at age, 85. If I earned 7%, on the other hand, I'd be a little bit above $1 million. So I would have won that kind of bet there. And these are all pre-tax returns, so we're accounting for taxes. If I earned 6%, I'd be 844 at 85, and so on and so forth. And then highlighted in green, I have the crossover points. So stated differently, at 4%, you're going to have to live well beyond 100 to hit that crossover point. The crossover point for 6% is somewhere around 90. 7%, you saw it at 85, and then 5% is at 96. So really, it's just to show how valuable or how powerful this type of product could be, that for somebody that wants to leave a legacy behind, or has, like I said, money on the sidelines that they're not going to touch and they want to pass on to their kids. Again, 4% all the way past 107. So I'm going to stop here for a second. I had a question, and I think they were asking about the accelerated benefit riders. And they asked the rest of the death benefit would still be paid at death, ? So that's the question. And the answer to that, assuming you're referring to the accelerated benefit riders, is no, you're actually accelerating the $1 million and receiving those the accelerated amount. So like, for example, on like a severe impairment, it was somewhere around 700,000 to 800,000. The insurance company is discounting the $1 million down to, that 700,000 or 800,000 and giving that to the client. Now the client could choose to only accelerate out of the $1 million, 500,000, let's say, and then keep the remaining 500,000 of death benefit. So I hope that clears that up for that question. Moving on, my second, what I would call strategy here, or sales concept, is really leveraging the return of premium portion of this product. So many times clients and maybe other financial pundits will argue about term versus permanent, buying term and investing the difference. And really, the sorry, the myth is that by investing the difference, you're gonna earn a better return. Your money is going to be more accessible, and you're going to earn a 10% return on your mutual funds or whatever. The problem is a typical 20-year period investor only earns maybe 2.5%, which is kind of an interesting study. So really, your clients have heard buy term and invest the difference, and they'll no longer need coverage after the term is out. And the problem is, things happen in their life. So, maybe they want insurance rather than need it. Maybe they've, done different things. So, the reality of it is life ends up happening and they still maybe want rather than need. I wouldn't even say need. They might just want the coverage after the term period is over. So that's where this type of strategy can really come into play. So again, I'm just using the same assumptions that we've used in the rest of the proposal, but what I've put together here is a comparison between doing the GUL or buying $1 million of 30-year term. So I'm paying for the guaranteed UL over lifetime, so $10,000 a year for life. The 30-year term costs about $3,800. So 10,000 minus 3,800 is about the $6,400 that you see underneath the side fund here. I guess I could use my laser pointer. So I've got the 3,800 term premium, then I've got the 6,400 going into the side fund. Now, if I, assume a specific interest rate, and I'll show you what when we go to the next page. If I assume a 6.5% interest rate on the side fund and I accumulate that cash value, I end up with $205,000 of cash value. If I take a look at where my surrender value is on the GUL, it's 205. So stated differently, you'd have to earn guaranteed in your side fund 6.5% to match buying the GUL and then surrendering it after 20 years and taking your money back. So I think that's pretty powerful. And really the numbers are about the same when you look out to 25. So about the same story. You have to ends up being 5.22 to match it. The 286 as if it earned the 6.5%. So the actual return to match it exactly is 5.22. Still, where are you going to get 5.22% guaranteed? But really, the underlying benefit of all of this is if your client decides that they still want or need the coverage after that 20, 25 year period, rather than converting a term and paying a much higher premium, they just continue paying the 10,000. They don't have to get re-underwritten, decide to do anything different. I mean, they have a lot of flexibility in here, which I think is extremely powerful with regard to that. So here's simply the numbers pages. As you can see, I have the term premium of 3,800, the investing the difference at 6,400, and then I have the the side fund value, so to speak. And then this goes out to I have your 15, and then I have your 20. And again, this is on the right hand side is being run at 6.5%. And then I go to year 25, where my surrender value is a little bit less than assuming 6.5%. But again, where are you going to get a guaranteed 6.5%? So it's a pretty powerful story, especially as an alternative to term and with somebody who's maybe adverse to an index product. So those were the main highlights that I wanted to hit with this product. Number one, we have the guaranteed cash out rider, which I think, as you can see, is extremely powerful. Number two, I have the accelerated benefit riders. for critical and chronic illness. And then finally, I have a competitive price on this product. I see this really fitting for folks who are considering, having a legacy and want to lock in that insurability, as well as maybe have a little bit of flexibility compared to any other GUL on the market. No other GUL has the flexibility like this particular product. So the next steps, let us know if you need any quotes or anything like that. We'd be happy to run them for you. I'll be following up with everybody after this presentation is done. You may also hear from my internal Brendan, and we'd be happy to help you. I got a question. What is the minimum face value? Minimum face value is 25,000. So it actually goes down pretty low. One thing to consider is that there's a significant break point at 250,000. So if your client wants 200,000, the 250 premium might actually be less than the 200,000. So that's just something to keep in mind. But minimum face value is 25,000. But anyways, we can follow up with you, and we'd be happy to run quotes. Send me an email. My email address is jordan.pence@american-national.com. You may also have my advisor's resource email as well. You can use that one. And like I said, I'll try to follow up with everybody. If you have any immediate needs, please reach out, and I'll maybe stick on here for a few minutes just to answer any lingering questions that anybody has. But thanks again for attending our webinar today, and we will, like I said, follow up with all of the attendees and go from there.